EM represents some really attractive investment opportunities. The volatility has really been a function of a few issues. Obviously, we had the COVID pandemic, then we had geopolitical tensions, Russia obviously, but more recently now in South China Sea. And we've also had inflation issues arising, not just Australia, but everywhere around the world. And interest rates as a function of that have been increasing. It's interesting, just from a valuation perspective then, emerging markets are very quick to discount a lot of these issues. And so rates have been rising in the emerging market sector quite significantly early on. Not just through central bank tightening, but also through, say, investors in the bond market. So the 10-year bond yield in emerging markets is priced around 4 percentage points above the equivalent to the 10-year bond in developed markets. And that's important because if you think about the previous tightening cycle that was happening in the United States back in, say, 2013, the spread was only about 1 percentage point. You might not think that's important, but that was a time when we had the taper tantrum and asset markets were quite volatile as a result of that, particularly in the EM. But we think that there's more resilience at this time because of that premium that's already in the emerging markets. On the equity side, the valuations are also attractive. If I look at the emerging market index, the price to earnings multiple is around 11 times. If I compare that to the All Country World Index, which is dominated by developed markets, it's probably around 14 times. If I look at the price to book value for emerging markets, it's around 1.5 times, and it's closer to 2.5 times for the All Country World Index. So on those bases, it's actually a bit more expensive. So we see that there's fundamental attraction being in emerging markets, there's structural growth, and so we think it's an attractive time to invest. We actually like jurisdictions like South Korea and also Mexico. Both countries offer reasonable growth. They have quite supportive regulatory environments. They both have low levels of unemployment. They have quite independent central banks. They've got fiscally responsible governments, and they also have good social stability. So for us, they're jurisdictions that we like. A couple of names in those jurisdictions. I mean, in Korea, Samsung Electronics we like. That's a company which is involved in the semiconductor and consumer electronics space. They're a manufacturer. They're a leading company in those areas. Look, Samsung's a great company. It's been growing its top line at around about 10% per annum over the last decade, and they've done it with no gearing. So they've had cash on balance sheet, and they have recorded very high levels of returns on their invested capital, which has been wonderful because that then flows through to shareholders and investors accordingly. And that very nature of semiconductors and consumer electronics is really playing to what we see as a strong thematic, which is the growing demand for computing power. As the world goes through technology advancements and we're seeing more sort of digital applications. So it's not just through the consumer space, mobile phones or personal computers, but it also includes, say, data centers on the corporate side, which are obviously helping things like cloud migration by companies. So they're at a really sweet spot, we think, and they've had proven performance, and so we like Samsung. In Mexico, América Móvil is the leading telecommunications provider in Latin America. It's remarkable. They address 350 million subscribers on their wireless devices as customers, and they're either one or number two in their respective markets across the region. And they've also had reasonable returns on capital, but these are expanding because what's happened is, as they've invested in their network and they have the leading network across the region, there's more and more applications now through that evolution of technology and through the development of the handset. We saw it going through 2G and 3G and more recently 4G, and now we're on the verge of, say, 5G. There's an expanding suite of applications that consumers can make available. So that's a lovely tailwind as well that we see coming through for América Móvil. So there are a couple of companies that have been proven performers, exposing our shareholders and clients to strong demand and good revenue growth. And that's been important because it's through revenue growth that you then get cash flow generation, drops through to the bottom line through profit growth, and that's obviously how we then get returns to our clients. We conduct quite deep financial analysis and modelling of potential investments within the universe that we're addressing, and we become very familiar and quite detailed with our knowledge through modelling of companies, businesses and their prospects. And that level of familiarity and confidence means that we're able to have quite a high conviction portfolio at the construction stage of the process. Look, on average, the fund would hold around 25 to 35 companies in the portfolio. And because we're looking at long-term factors, we tend to then have a very low turnover rate because we're not trying to trade and invest for short-term issues. And the turnover rate would be relatively low, around about 25%. So high conviction, concentrated, low turnover. These are ways we manage the portfolio risk. Also within the portfolio, those companies, roughly half of the companies we have in the fund would be net cash. So again, like the Marucci example, they don't rely on cheap credit, again, to grow their respective businesses. They are organically developing their businesses and growth. Also, half the stocks have grown their top line, their revenue, by about 18% annually historically. And that's really important because in addition to managing the portfolio risk, managing the risks to, say, interest rates and financial risk, is the risk of, say, inflation. I touched on it earlier on. We're in an environment of higher inflation, at least where we have been in the past. So to have companies that are growing at rates well above even elevated levels of inflation is very important to keep growing that, not just the revenue pool, but the profit pool, and therefore really drops down to shareholders in wealth generation longer term.